Insightful value here. And if you're watching, you're about to uncover why Domino's stock has been on a downward swing lately. The share price has dropped significantly in recent weeks, raising questions. Is this just a dip or a deeper warning signal? This video is for informational and educational purposes only, not a financial advice. Make sure to hit subscribe and like. Let's dig into the details. Domino's Pizza Enterprises is a leading global pizza delivery and takeaway company operating in Australia, New Zealand, Europe, and Asia with thousands of stores. From a value angle, we see strong revenue, reasonable margins, but also some red flags. The firm's recent quarterly results showed revenues growing but missing estimates. Total revenue in fiscal fourth quarter was about US $1.44 billion under the expected US $1.48 billion, and earnings per share were also slightly below projections. Gross margin declined, and they even posted their first operating loss in 20 years due to write-downs and restructuring costs. They announced a plan to close over 200 underperforming stores, primarily in Japan and Europe, which should help save costs long term. From a financial performance standpoint, the gross profit margin is still solid, over 56%, and net margin around 4%. Operating margin remains in the low double digits. They maintain a strong free cash flow. For the Australian unit, forecasts show cash flow per share climbing and dividend yield around 5%. Speaking of dividends, the board recently increased the quarterly payout by about 15%, currently at US 1.74 per share annually in the US and AU 0.56 per share semi-annually in Australia. That streak of consistent increases reflects a healthy capital return policy. But what about the risks? The revenue miss and margin pressure point to weakening demand in key markets like the US and Europe. Same-store sales growth slowed to near zero in the US and just modest gains internationally. Cost pressures, higher food, labor, tech investments are trimming margins. The decision to close stores includes upfront one-time costs. They are also rethinking expansion plans. The target to open 100 new stores by 2028 has been shelved, so why consider investing now? The share price drop may offer an opportunity. Margins remain decent, free cash flow supports dividends, and aggressive cost cuts could restore profitability. Berkshire Hathaway's addition to their stake also demonstrates institutional confidence. But why hold off? External economic weakness, operational restructuring, and uncertainty in Asian and European markets keep the risk elevated. Until they prove same-store sales recovery and margin stabilization, caution is warranted. In the past decade, Domino's has steadily increased dividends at a Sierra's 18 to 22% annualized, showcasing commitment to shareholders. Recent growth slowed, but payout remains intact and yields are attractive. At Insightful Value, we deliver deep dives into undervalued stocks like this, breaking down the numbers and giving you digestible insight. For more details on this analysis and other opportunities, head to insightfulvalue.com. That's it. Don't forget to subscribe, smash like, and check out the website insightfulvalue.com.